Welcome to Markets Now. I'm Michelle Rook with Darren Newsom, Senior Market Analyst with Barchart. And we're seeing some mixed trade in both grain and livestock futures this morning. And let's start maybe dicing apart the grain market, Darren. Wheat market is up again here this morning. Do you think that we continue to see the market a little bit concerned geopolitically? Are we putting in some premium because of that? Or is it just all still fun short covering?
That's a great question, Michelle. There's probably 1,000 opinions or more on what's going on in the wheat. To me, it still looks like some fun short covering. But that being said, as we saw in last week's CFTC commitments to trade report, particularly the legacy futures only, funds had dramatically cut their net short in both winter wheat markets, Chicago and Kansas City. So, it's very possible that funds are getting close to par or an even position. So the question now becomes, with fundamentals, our reads on real fundamental spreads, basis, and so on, still leaning towards the bearish side, do funds have a reason to go net long? And right now, I don't see it. Right now, I don't see any big shift in global supply and demand, geopolitics, all of these things. It's always coming up, weather and so on. But could it happen? Absolutely. I mean, that's always a possibility. It certainly could happen. Right now, I'm not seeing it. There's nothing in the markets that are indicating it, except for the fact, the wheat subsector wants to continue to move higher.
No doubt. And like you say, maybe no catalyst to go long in wheat or maybe any of the grain markets at this point. But if wheat keeps moving higher, will it continue to kind of pull corn and soybeans with it?
I'm not a huge proponent of that idea. I mean, it certainly could. I mean, to me, wheat has its own supply and demand issues, as do corn and soybeans. So, to me, more often than not, wheat is, as I said, its own subsector within the grains sector. It likes to do its own thing. It likes to march to the beat of its own drummers. We all know, anyone who's ever been involved in the wheat market know there is really no logical rhyme or reason to it. Could it possibly pull corn and soybeans higher? Let's just say yes. I'm not a huge proponent of that. I'm not absolutely convinced. But if we just see a screaming rally like we saw in 2008 in the wheat sector, in the wheat subsector, yeah, I mean, it could certainly spill over into corn and soybeans.
You bet. Right now, it feels like the corn market is kind of caught a little bit between wheat going up and soybeans maybe going down. But is that market also just kind of range bound, waiting for something different to move that market?
Yeah, corn's big enough to trade on its own. Yes, there could be some spillover activity from both other markets, but right now it's just found an equilibrium. Can't even say it, equilibrium between $4 and $4.40, and so it's sitting comfortably right around $4.20. We've got harvest going on, we've got bushels coming in, we've got exports going out, we've got other demand using up supplies, and so future spreads are flat, basis is generally flat. Futures are generally flat. There's just nothing exciting, at least at this time, going on in the corn market. And I just don't see anything changing that scenario. We know we've got good export demand right now, but it's being compared back to the last couple of years when, the U.S. struggled to move anything as far as exports go. So, but we're seeing more feed demand. We've still got solid ethanol demand. So, it's just an equilibrium situation where, corn doesn't have a reason to go up. It doesn't have a reason to go down. So it sits here comfortably.
Yeah. And export sales were good this morning, again, here on a weekly basis, as you point out. But I wonder, do we have maybe a lack of harvest pressure or big harvest pressure yet, just because farmers are not far enough into the harvest? And so they're putting some of those bushels into storage, and we won't see that big harvest pressure until we get a little bit farther down the line.
That's certainly a possibility. U.S. producers, regardless of how the market is set up, regardless of what the market structure is as far as carries and so on in the different markets, they like to sell soybeans and store corn. And right now, it certainly seems like, given the weather that we've seen, it hasn't rained in however many months. Soybean harvest is rolling along quite quickly. Corn's still going, progressing as well. But again, those bushels, as you mentioned, are going into storage at some point. Those on-farm storage facilities are going to fill up, and then it's going to start coming to town. Will that finally put some pressure on the D-Smart spread? Will it be before? It should be before December goes into delivery. But we also have to remember, again, I mentioned the Goldman roll in soybeans. Goldman roll starts in corn early next month. So there's a lot of things to come into play. I do think that the extra bushels coming to town are going to play a role. We'll probably see it in basis more than anything else.
What about soybeans? A little pressure again this morning, and we've basically been consolidating off of or under the recent highs. Decent exports this morning, almost 47 million bushels. But again, we're in the middle of harvest, and we've got some rain in the forecast for Brazil. So is that kind of dominating the trade?
I think it is dominating the trade at this point, and that would be out in the May-July spread. As far as the Novjan, it's everything that you mentioned. We've got a quick harvest coming in. We are seeing some seasonal demand, and that's what we have to remember about some of these bigger sales and shipments numbers that we're seeing here early in the marketing year. The first 6 months of the marketing year belongs to the U.S. I mean, that's when we get most of our business done, albeit we're still a secondary supplier or a secondary player on the global stage. So, I mean, it's just a seasonal move. Again, if we compare it back to what we saw last year, nothing overly surprising in the numbers that we're seeing. But we have enough demand to offset some of the supplies that are coming in, not all, because we have seen some pressure on the Nov-Jan spread, Jan-March as well, and basis continues to run near its previous 5-year lows.
Yeah. So we are, like you said, removing a little weather premium from the soybean market. I want to go back to what we were talking about when you said funds really don't have a reason to go long here. But let's talk about money flow, because what do you see in terms of money flow with the dynamics that we're seeing? We're going into the election.
Mm-hmm.
We've got, energies moving higher. Are there areas that maybe the funds will go to now instead of grains?
Yeah, I appreciate the question. I just wrote about that again for Bar Chart because I had the question come up from a gentleman yesterday. The stock indexes are in a long-term uptrend. We know that they have been for the last couple of years. But I mean, they've been going almost straight up, and that's usually a scary situation. And so the question was, could some of that money come out of the indexes and go to other markets? It certainly could. But when funds pull some of that investment money out of stocks, what they're going to look for are, other markets that have bullish fundamentals. We've got U.S. Treasuries that look good. They're in a long-term uptrend as well. As you mentioned, energies, particularly crude oil, they have an inverted forward curve as far out as we want to look. That's a bullish supply and demand situation. In the softs, we see inverted forward curves, or at least inverted spreads. It's some of the deferred contracts have some thinner trade volume, but at least nearby we've got inverted spreads. So that's bullish, and these are all tied to global weather. So there's markets I think that these funds could move into. Do grains fit into that category? Not at this time. But it could change. Again, if it turns hot and dry again in Brazil, and all of a sudden there's getting to be concerned about Brazil's first corn crop in early 2025 and its 2025 soybean crop, that could change the picture. That could change the spreads, starting with the May-July situation in both corn and soybeans. And we have to remember, in corn, that May-July spread is still bullish. And so that could start to draw some of that investment money in longer term.
So CPI data out this morning at 2.4%, so just slightly above what was expected, but really we're getting close to the Fed's targets.
Mm-hmm.
And so is that enough reason for, I know the stock market is at a really high level. You say, what is there for people to keep buying on? Is there really any reason for them not to buy when you look at the fact that we're getting inflation under control?
Yeah, I go back to my market rule number 7: stock markets go up over time. So there's still a comfort in finding stocks and buying stocks of companies or indexes that one likes. Do we have to be careful up at these levels? Certainly. And it's interesting you bring up the CPI. I view them as I do any government number. I don't take them all that seriously, but what I notice is that most of the commentary that is around any government number, particularly when it comes to economic numbers, they don't have anything to do with economics. It all has a political bent to it, depending on which side of the aisle you're on, whether or not these numbers are good or bad, whatever the case might be. So, I mean, we can basically throw them out just for that alone. Do I think that we could see a pullback in U.S. stock indexes? I do. And I think it's going to come down to, again, they're going to be looking for some of these other market sectors that haven't had these huge runs, that haven't gone to new all-time highs. But that being said, I'm not looking for a collapse in the market. I think the overall economy is good. I think there's still a lot of investor interest in buying stocks across the scale, Nasdaq, Dow, and S&P. So I'm not looking for a collapse, at least at this time. Certainly, given what's going to happen here over the next month and the chaos that could ensue, that could certainly change the picture.
Yeah. And you mentioned the stock market. What about cattle? Is the cattle market kind of like the stock market, where it's getting hard to find buyers up at these higher levels? I mean, we've had 2 days now where we've corrected here. And is that just the case until we get some cash trade maybe to lead us higher, or not?
I think you hit the nail on the head there, Michelle. We've seen the cash market, at least the cash index, kind of get stuck up between 185 and 190 on live cattle. So it does raise the question: Is cattle going to be like the stock market? Is it going to be like gold? And it just, regardless of how high it is, it continues to find buyers. I think there's more fundamental reason to say maybe not. The market may need to pull back a bit. This week has been an interesting mix. There's been days when we've seen commercial buying, some days when we see commercial selling. Likewise, on the non-commercial side, they'll spend some time buying, they'll spend some time selling. There seems to be a lot of uncertainty with the market up at these levels. So I think we have to be careful. If I'm a producer and I've been, because of all of the unknowns in the market, we've been buying puts along the way, low volatility and so on. I think you just continue to do that. You just continue to sell cash into the market and lift your puts if you have them.
Okay, thanks so much, Darren Newsom with Bar Chart, and that is Markets Now.